Good morning to everyone. Thank you to all co-panelists, Siddharth Bhai, Arjun ji, Jeet, Utpal ji, and Ashish Bhai. It's a really privilege for me to be part of this panel along with you esteemed angel investors and VCs. So I will begin with my first question. What are the key factors that angel investor and VC consider while evaluating a startup for investment?
Hi everyone, thanks for being here on a Sunday. So you asked a very broad question where that's our job, right? It's a day-to-day thing in terms of evaluating so many startups. But yeah, from our fund perspective, I can tell you one thing that we are founders first. Since we come in very early stage, there's not much data that we can rely on or underwrite it. So it's all about our, the kind of vibe that we get from the founder. And post that, of course, we get into what kind of problem he's solving, whether we're able to understand that, build conviction, what kind of a market he's building in. And it could be as, traditional business versus even innovation. So we're open to both such, founders. But yeah, broadly, it's from our early stage, it's going to be founders for us.
Yeah, good morning, everyone. And so good to see so many people out on a Sunday morning. Really tells you the state of where the Indian startup ecosystem is. So thank you so much, Jeet, for inviting us here, and happy to be a part of the conversation. I think, look, Rajesh, you asked the question, and I think everybody's answer will have founders at the core, founders at the center, because that's what early stage investors do. I'm going to maybe talk about two more specific points that I look at. I've met thousands of founders now since I exited my business and started this journey of being an investor. So on the founder, one specific thing, right? Actually, two specific things. One, look, there's lots of problems to solve, right? There are a lot of ideas in the drone space, in the defense space, in the space tech space as well. But I had no right to win in that space, right? I had 150 years of family legacy in Ayurveda. And that was my right to win, to take forward an Ayurveda business. So I look for a right to win in founders. And the second thing is, look, it's very glamorized. Startups are now coming on primetime television. There are TV shows being made about startups. There are news articles, Instagram reels, podcasts, and entrepreneurs and startup folks have become celebrities. But the journey is truly a roller coaster. And there are lots of downs. There are ups, there are celebrated, but there are lots of downs as well. So the second thing in a founder that I look for is great resilience and the ability to fight through tough times, because each and every one of those companies that you are celebrating, that you are talking or calling a unicorn, that you are celebrating their stock market listing, all of them have also had near-death moments where things are looking like they're not going to work out, right? And being able to fight with your back against the wall is another characteristic I look at. And the third thing I would say is, especially in the consumer space where I like to invest, there are lots of personal biases that come in, right? Like, you consume a product, you wear a pair of shoes, you like a t-shirt, you wear a smartwatch, you have this specific food product, you use this home decor product in your home. So I think personal bias comes a lot into investing, especially in the consumer space where you use the products. I actually try to do the opposite, right? I try to say, hey, I'm going to remove the way I consume when I evaluate this business. And usually the way we consume in urban India may not be the way the rest of India consumes. And so I'm going to remove this personal bias, try to invest sometimes in the opposite of the way I consume, and look for enough growth in market from the time I invest, right? So, for example, our fund was an investor in a company called Sula. We just exited that investment. Sula was a much longer journey because Sula truly built the wine market in India. They were still 55, 60% of the market share in wine. And so that growth is dependent on how that market grows. As opposed to if I'm investing in a business, I want to be able to see 5 or 10x growth availability in the market so my startup can grow. So these are three more specific things that I look at when I look at founders and markets and investment.
Basically, of course, founders are a great call and great call for execution. But with founders, I believe the TAM and the right product is also very important, because in many startups, which we have also seen, the founders are very brilliant, but sometimes selecting a wrong product or a wrong market fit is a problem for the startups. So sometimes seeing what is the TAM, what is the product, how much success a product will be able to do. So yeah, I believe truly in having a right product and right time for a startup to be successful also.
Uh, Good afternoon. I think we are living in a world of digital transformation, where we are already loaded with all the information. The only thing is, what is the right way? I think so. That's the most important thing. Now, having said that, I basically wear two caps. At a VC as well as an angel investor. But let me just lay down four fundamental principles, whether it's VC or an angel investor will look at. The first and foremost thing, what has been told is founders. I think so that's the most important thing. Second is the idea. What is the idea that they are developing? I think that's the second most thing. The third is the product market fit, whether the product is before the time, on the time, or after the time, because somebody may be following some success stories. And fourth and final thing is basically their ability to generate a long-term return for the investor. That's basically ROI. So I think that these are the four fundamental pillars which I believe, and I think so this is what we are also following as a VC or as an angel investor.
Thank you very much for having me over. I'll talk about 3 points. Founder has been spoken enough. Specifically on the founder, the only thing that I would like to add is the ability to obsess about the problem a little more than the solution becomes a little crucial. We know that when we start with a certain solution, and we have seen n number of businesses in the market, many in our portfolio as well, where you start from a particular solution and you evolve into a very different solution over a period of 10, 12 years that we have seen the journey. And from that lens, what we have realized is it's great that we are proud of the solutions that our founders are building, but the ability to evolve the solution is a lot more important. So that happens only when there is going to be obsession about the problem that we are trying to solve from the lens of the founder. The second thing that we definitely are very keenly watching is the market size, which somebody referred to as TAM. The key factor within the market size is the fact that there will be a lot of effort done on our side to have a thesis of our own. And there, you're not as much trying to look at the founder conversation and say that I'm checking the boxes, whether the founder is saying the things that I have documented in my thesis, but you're trying to figure out as to what you have learned by doing that thesis and what are the things that are similar, what are dissimilar, and you're trying to form patterns and trying to make a judgment call. The deeper the variance, the deeper the hard to dig and figure out, okay, how will we cover the gap? So it's not that if it's not a conformist thesis, it will get rejected. The idea is to eliminate biases. And the third factor, which has also been important, lesser in terms of percentage weightage, but is important, is the ability to be able to raise future rounds of capital as well. If we are trying to cut down a journey of a business and cut it down to a 10, 12-year journey from startup to a listing, that is what a VC fund will typically want to invest into for at the outer limit. We are definitely going to need multiple rounds of funding and scaling up rapidly. And therefore, it will mean that the team that you are backing should have those dynamics where 1 or 2 members of the team are going to focus on the business, which includes sales, product, marketing, etc. And there has to be somebody who is having the ability and the dynamism to be able to be out there and tell the story of the company better than anybody else in the market as well, because not always is the best product going to win. It's a combination of various things, including the ability to fundraise at the right time, pragmatism to understand that I don't have to always talk about valuation, the maturity to understand it's also about dilution. All of those factors become inherent. Within this point, all of the aspects come in, ability to think through unit economics, profitability, all of those cliches come in. But broadly, these are the 3 highlights, which is the founder, market size, and the ability to fundraise.
Yeah. In our panel, we have angel investor also and VC also. And I can see that couple has wear both the hat in their career. So my question is with respect to how VCs and angel investors are differing while evaluating a startup in their approach and investment criteria. How an angel investor and a VC differ in their approach while evaluating any startup?
So I've seen both the journeys, right? As an angel investor, I've put in almost 150 checks in about 120 plus companies over the past 5-6 years. Most of the investments were learning, but the high conviction bets where we put in a larger check size, fortunately, they're doing well. So now in the last 3 years, I'm wearing the VC hat as well. So the key difference I've seen is when you're investing your own money, sometimes you tend to lower the bar. You say, ठीक है, चलो थोड़ा 5 लाख डाल देते, let's see how this fares up. So you're not that disciplined when you're cutting angel checks. And initially you were, at least me personally, I was looking at, oh, okay, Kunal Shah is investing. So he must have seen something in this, let's tag along. But later on, I understood that each investor invests for different reasons. Like Kunal Shah said, I invest just to give back to the ecosystem. He doesn't care what the founder is, meaning he doesn't put in a lot of effort he just wants to support the ecosystem. So I realized it's very important to build your own conviction when you're investing. And so when I started wearing the VC hat, I was really concerned whether I have the ability to invest other people's capital. So what happened was, so I said, let me try this out in a small way, create more like a syndicate and start investing. So there, initially what we saw was all us 3 partners. We were all angel investors before, and one of us was a VC partner as well. So the key thing that happened was we became even more selective. We started raising the bar several, notches higher. And more importantly, you become disciplined. See, as an angel investor, you have unlimited bullets. It's your own money. You can keep deploying from your balance sheet. You're also, it's patient capital, right? You can stay with it for as long as possible. You don't have pressure to exit. But as a VC, you have limited bullets. You want to invest only in 20, 25 companies. And second is each investment should be a potential fund returner, so you become even more careful. You get into DD. As an angel investor, you don't even have the say in terms of doing due diligence. You rely on the lead investor or the other major investors in the cap table. So as a VC, you end up doing all those stuff. So I think of course, my fellow co-panelists will further elaborate on this, but these are the major differences I could see.
Yeah, I would agree with Sid, honestly. I started my journey in the investing world in April 2021 when I sold my business, and I started as an angel investor. Objective is really important, and a lot of times angels may have other objectives like giving back to the ecosystem, like learning, like engaging with founders, etc., all of that. Honestly, for us, we earmark 10% of our exit from Dr. Vedya's to give back to the ecosystem. Yes, financial returns is part of it, but as an angel, you can take a punt, right? So you can say, hey, this seems like a crazy idea. If it works, it'll be outstanding. If it doesn't work, okay, it was a chance I took. As a VC, you have other people's capital, as Sid said, lesser bullets, and also a responsibility to build a detailed thesis note. Think about things like, what do the return metrics look like? What can go wrong in this business? How do I project this business out over the next 5 years? So I think there's a little bit more method to the madness, a little bit more structure to the way each investment is done. As an angel, again, you will sign an agreement. You will maybe not go through the agreement in detail or have any right or negotiating leverage in the financial documents or the definitive documents for the investment. As opposed to as a VC, you are actually involved in negotiating the definitive docs, you're involved in the DD, you're involved in safeguarding your rights, etc., all of that. So I think there are nuances in difference, but I would say now that I've been a VC and spent time as a VC, if I'm to look at my angel portfolio as well, I would add much more rigor and much more detail to the way I make each investment. And I think at the end of the day, capital is capital, right? Whether you're putting 5 lakhs, 5 crore or 50 crore, whatever that amount is, it's meaningful money to you, right? And so 5 lakhs may mean a lot to me, it may not mean a lot to you, or 50,000 may mean a lot to you and it may mean a lot to me as well, right? So whatever it is, whether it's 1 rupee, 5 rupees, 10 rupees or 5 crore rupees, I think the learning from being a VC now in relation to my angel investments, which I have done, and some of which I continue to do, is add more vigor and more detail to each investment because capital is capital and it's not fungible.
Thank you, Arjun. I have a further follow-on question with you. Can you share an example of some successful investment made by you as an angel investor and as a VC? and what factor contributed to success of those companies?
Look, I've been in this world for 2.5 years, so the cycles are quite short. I've had 2 exits. We've sold 2 companies. One is the largest peanut butter on the digital ecosystem called MyFitness Peanut Butter, and then we sold another company called Better Alt, which was doing Indian superfoods and Ayurvedic products for global markets. I would say I have a lot of investments that on book look successful, whether it's Jimmy's Cocktails, or it's Perfora, or it's Indus Valley, or it's Go Quick, or it's Jar. There are more than 100 investments that I've made. From the fund, we've invested in Cuckoo FM, we've invested in Dil Foods, we've invested in Eka Care, invested in Entry. All of these investments on the book look good because they're 1.5, 2 years old. They have a lot of markups, but I think there is a massive difference between book value and actual returned value, MOIC, capital distributed. Cycles are longer in the type of investments that we do. So average cycle of investment would be at least 5 years. And so I've yet not finished that cycle. And I think the important learning from that is my first ever angel investment was a company that in 6 months was written up to 12 times. In 6 months, we went from a 15, 18 crore valuation to a 210 crore valuation. And everything seemed like exciting and the company was growing and all of those things, right? That company is now shut down. So just book returns or paper returns don't mean as much as actual returns or outcomes do, right? And there are various reasons for the company to shut down. Maybe they raised capital from the wrong kind of people. Maybe they tried to grow too fast. Maybe they overestimated the market. Maybe the market turned. Whatever that may be, that 12x is now written down to 0. And so had I believed that that 12x was actually capital available to me, it would have been a very different story.
Thank you. Utpalji, my next question is with you. I just wanted to understand the importance of practical experience and expertise of a co-founder while evaluating that startup as an investor.
I think so. There are a lot of nuances, relating to identifying a co-founder and working with them. We have seen ideas coming from every part of India. Now, it could be a solo investor or a solo founder. It could be a team. What we really think is there has to be a synergy between the founders. Technically, yes, I think so. All of them should be capable of seeing the same vision, having the same passion, and running the business for a long time. I think so. I'll just put it very in a crisp way. I really don't want to elaborate much on it because, I think so if we start discussing this, there will be a long thesis. But a team who's having the same vision, same passion, and ability to run the business, rather than having any kind of a difference. That's basically what we look at, founders, co-founders, or the founding team.
Ashish bhai, I wanted to understand the role of market potential with respect to startup.
Sure. Like I said in my opening remarks, the second factor is the market. And here it is important to understand that when it comes to market dynamics, one could end up being the second, third, or the fourth company in the space. We have seen when we invested in the beauty and e-commerce space, there were half a dozen players funded back in 2011 through 13. And Purple was one of them. From another 2 years of experience and journey, others were pretty much out. And then there was Nykaa, which came. So, and then there was, of course, many other businesses that came, some from a different lens, some from a platform lens. So the market has to be a very critical factor because you could end up investing in a really great team which is solving a really innovative problem which applies to a very tiny universe of people. It will not create a big enough outcome potential. And it will be found out very quickly because an institutional investor, when they come into the business, they are trying to think about this as a business that can potentially return the full fund. So even if your investor is a 100 crore fund or $100 million fund, they want 2 or 3 companies which potentially are going to return bulk of the end state returns that are expected. That is not going to happen without the market potential of every single company that we invest is to be big enough. And that's where I think it also kind of answers a part of the previous question that as an angel, I might have the discretion to say that it's okay, I might only get 3x or 5x. It's my capital at the end of the day. As a fund, you are trying to make sure that you have to get dragon outcomes. The power law has to play out. And for the power law to play out, only two factors matter: the execution capability of the founding team and the market size and the navigation of the market size. Which is why enough of SaaS businesses that you fund, if they are hardcore India first businesses in the phase of 11 to 16, many of them didn't get funded. Or if they got funded, they didn't get funded following on or later on. And people were saying, I want to fund a business with the SaaS if it's a US first kind of a business. And of course, now it's a very different market dynamic. So it plays a massive.
Siddharth, I just wanted to understand, how do you look at scalability and sustainability as a factor in the business model of a startup while investing?
So sustainability comes only from one thing, bottom line. Sustainability comes from only one thing. You need to have good unit economics and you need to be profitable in the end. And I keep telling founders, the best source of capital for you is not VC money or debt or outside capital, it's your customers. Get customers, start getting in revenue. Once you have that, then money will follow you from all angles. Like they say, right, bankers want to actually give money to people who already have enough money. So similar thing happens here. So that's from the sustainable point of view. And in scalability part, again, see, what we are looking at now, if you talk to any VC, we are going back to investing in traditional businesses. The ZERP environment, the zero interest rate policy, which fueled this growth in the last 10, 15 years in terms of playing GMV games. You're burning money like crazy. Of course, you're creating good products, but in the end, you're not profitable. So this mindset of VCs has changed massively in the last 3-4 years. You're seeing now investors investing in traditional offline plays. So now here you ask, now where is the scalability if you're investing in, let's say, a coffee chain, where capex is always going to be a bottleneck, working capital ends up being a bottleneck. So, but we are seeing a lot of business ideas coming our way where the payback periods are less than 2 years. They're reaching operational efficiency in matter of 4 to 5 months. But then we still ask them, to open new stores, you'll always need more money. So how are you going to solve for that? And there also we are seeing models where the internal cash flows, after they reach a particular steady state, those cash flows are able to fund future growth. So this is one way where we are seeing, back to basics. We are all building dhanda businesses now, and it's actually exciting time for us to invest, where it is both sustainable and also you're seeing scalability as well. You're not going to see massive, 500, 1000x kind of outcomes, but we are seeing, more like PE plays, but happening early stage.
Thank you. Arjun, my next question is for you. What are some common challenge and pitfall startup face while seeking investment from the world? What are the common challenge and a startup co-founder face while raising the fund from a VCs?
Yeah, look, I think firstly, the environment has changed from 21 and 22. I think Ashish will also probably agree with me when I say this. So I think 21 and 22, capital became really easy to get. And so people started believing that that was the norm. The reality is I went and raised money in 2017 and 2018. It took me 1 year to raise the first round of capital. And the world is slowly moving back to that. The world is moving back to you will not commit capital and put millions of dollars in a founder you have not met in person. Zoom call is not the only way you will invest in a company. And, actually, I did a bunch of that. I drank the Kool-Aid. I must have invested in 20 companies only on Zoom calls. And looking back, I think that was rash of me as well. So, look, it's not bad, actually. It's good that founders and investors are getting to know each other. They are having conversations. They're meeting in person, maybe not just once, twice, thrice, or 4 times. The common challenges that startups would face today in relation to raising capital is, I think it's our fault as well as investors, but the bar has changed, right? So we are now asking questions like, what is your contribution margin? What is your path to profitability? What is your repeat rate? What is your lifetime value? How will this business ever make money? For some time, we had stopped asking those questions. And so startups that have gone onto the rabbit hole of just growth at all costs and acquiring customers without thinking about the unit economics will obviously have to change their model, change their way of thinking. And it's not easy, honestly. The second thing I would say is that investors are definitely more cautious. They are taking much longer to close round. And so you have to budget 6 months from the time you start raising capital at least till the time capital hits your bank. And so that could lead to runway issues for companies if they have not budgeted into this. And the third thing I would say is that there is much more caution in the way checks are being written. And so there may not be as much sort of vigor and enthusiasm and easy deployment of capital as there was 2 or 3 years ago. Again, I think it's a good thing, by the way, because you're now getting investors who truly believe, who have spent time to understand, who may be able to add a little bit more value into your business as well. So I think these are challenges that we will face as the startup ecosystem when raising capital. But I would say that in the short term, this may be pain, but in the long term, it's actually good, because at the end of the day, if you're raising money from someone and you are taking in their capital into your business, it's not a fling. It's at least a long-term relationship, if not a marriage. And so you got to meet that person once a month for the next 5 to 6 years. And so a pretty successful startup founder told me, raise capital from people who you're okay to have breakfast, lunch, or dinner with once a month for the next 5 to 7 years. And I think that is coming, and it's a good thing.
Thanks, Arjun, for giving a lot of hints to startup, how to mitigate those risks as well. Utpal sir, I just wanted to understand more on a DD process as a VC. What are the aspects you look on while doing the DD, while investing in a startup?
Well, let me just put it, and I think so I need to mention, where we invest. I think that's the first thing. So we invest at an idea stage, we invest at a pre-seed stage. That's basically an area where, no one would normally want to venture into because there's no certainty. The factors, what I mentioned earlier, is basically are the key factors because, there is not much information available, around the founders, not much information available around the financial metrics. So the kind of thing or kind of evaluation that we normally do is, who's the founding team, what's the pedigree of founders, how are they technically qualified? And when I say technically qualified, that does not mean that they have to be from IITs or IIMs, it could be from anywhere. The second and most important thing, what we look at, and I'm repeating for the sake of repetition, but the second and most important thing is, what we look at their idea, their solution, what they are developing. Third is product market fit. I think so that's the fundamental because that will basically give us an insight as to, what is the path and, how they are going to grow up. And fourth, looking at all the factors put together, we look at the fourth thing, which is basically their ability to, earn the return. And when I say earn the return, we are the first investors, we are the first check writers for any startup. But it's their ability to create a return for all subsequent investors. I think so we look at that parameter when we are taking an investment decision.
Thank you. Ashish, I wanted to understand from you, what are the factors you look while determining valuation of a company?
Thank you. So let me, rather than try and give you a very straightforward two-pointer, I'll give that as well. But let me try and take this a little differently. Because some answers might differ. At an early stage, valuations do happen on a combination of a few rules of thumb and a few of the experiences that have shaped that particular investment committee. So rather than going into just one or two things that might be relevant or resemble what we do, let me put out a couple of important principles. When a VC is looking at investing in a founder, like I said earlier, the expectation is that this business should potentially return the full fund. Let's stick to the 100 crore example, and the VC will make 25 investments. So the average investment will not be 4 crores. In the best of the company, the average investment could be 14 crores. Because in the best of companies, you have the ability to double down. Initially, you will invest much smaller amounts, and then you will have reserves. At 14 has to eventually get to 100, 150 crore outcome for the VC. So when we are evaluating whether it's a 100 crore fund or a $100 million fund, to the extent it's a reasonable size fund focusing purely on early stage, the lens with which anybody will be evaluated or any opportunity will be evaluated will be this. Can that get us a dragon outcome? Dragon means, can this become a full fund returner for us? Probability could be small. A VC really may not be very excited if you come and say that 3x to pakka hai or 5x to pakka hai. No matter how sure the probability of a 3, 4, 5x, The smaller probability of potentially a 30 or a 40 or a 50x is going to be driving factors. Not that we are trying to play a game of probability, but the intent is to try and go for things which are truly massively scalable and disruptive in nature, and therefore land up with high beta returns, and those by default are going to be risky for one reason or the other. Now coming to the specifics. So the factors that we actually do care for is whether it is a seasoned founder or a first-time founder, it has a bearing. Whether anybody here may like it or not, it has a bias in the mind of an investor that somebody has come in, covered the journey in the past, having sold the startup already, made 10, it could be sold out for only $20 million, whereas now we are trying to invest with the lens of generating a $2 billion outcome. But the fact that a journey has been undertaken and wound up successfully creates a positive bias vis-a-vis a first-time founder. Within the first-time founder, whether it is somebody who has done work in a VC-funded company versus somebody who is fresh out of college, has a bearing. So here you are not really pricing the equity. Here you are trying to work backwards and imagine a lot of factors and put some attributes on the basis of which we will get our alpha outcome. Very simple. The other factors do make a difference is whether it's a single founder versus a multi-founder team. In a single founder team, there will be a tendency to say that eventually this team will need a few other people at senior level to be brought in the next 1, 2, or 3 years. And at that point, investors also will have to dilute. So, okay, let's go in with a higher stake, and eventually all of us will have to dilute or make room. You can solve it by way of giving ESOPs or high MSOP tables and all that. But a simplistic way will be that a 3-4 founder team will be valued a little better because of the fact that it is little more diversified in nature. The key skill sets required to take the company from stage A to stage C are already in the team. The last factor which will have a bearing is the type of business you are going into. A few years ago, businesses which were hardcore consumer were valued much better vis-a-vis business of the B2B or enterprise nature. Things have changed for enterprise B2B businesses of late, which is in line with how the economy overall has shaped up and the track record and the ecosystem is. So there will be a lot of those buzzwords which do shape up, ask of the values from the founder, but never results into the VC term sheet. So using AI or a crypto or a blockchain or a neobank has helped the pitch, but never helped the valuation. So VCs that way, angels are going to be astute enough to figure out and come down to whether the buzzword matters in the business or it's a cliche, and they'll come down to it. So I would say don't get down to usage of that. That's all.
Yeah, thank you. One suggestion which each of you would like to give to any co-founder and a startup entrepreneur who is coming to you for fundraise, starting with Siddharth. One suggestion you would like to give to any startup co-founder who is coming to you for fundraise.
So one thing that we want to see right now is, founders to have enough skin in the game. Like, for example, during the, boom era, we saw a lot of founders raising a lot of capital, and post that, they start spending a lot. They're not in that stage of putting pressure on themselves, so they start taking, hefty salaries very early on when nothing is there. So we want them to be a little lean, and so that's why we say before coming in, whatever model you have, try to invest your time and a little bit of money, do your friends and family round, show initial signs of PMF at least, and then come to us. So this is mainly for first-time founders, but second-time founders, as I said, we are happy to, even get in at the idea stage. The main reason is we are seeing that first-time founders, they're more product-focused, but second-time founders are distribution first. And why distribution? So I'll give an example. The 3 areas where you can create a lot of value is, one is in IP or research and development, second is in manufacturing, and third is in distribution. Now you look at Apple, they are in first and third. They have great IP and they are amazing at distribution. They are valued at $2 trillion. Now Foxconn, which manufactures not only for Apple but all the other major ones, they are at just $40-50 billion. So there's almost a massive difference in terms of the valuations. So we want founders who are distribution first. In the end, you can have a great product, you can have a great idea, but execution and your ability to sell matters. And that is what we want to see early on, at least some signs that you're able to do that.
Arjun.
Yeah, I think since I've been a founder in the recent past as well. I think one thing which I've seen as the quality of best founders, and maybe I wasn't as good, but the quality of best founders, do what you got to do, do what you've got to do, get yourself out of your comfort zone and hustle, right? So I have two friends in the audience who are startup founders, Oleg and Deepa. I invited them to come for this event, and I didn't coordinate with them on the timing. And so I messaged them when I'd left, saying, by the way, I'm on the way for the event. And both of them said, hey, we have a lot of work to do, etc., all of that. But okay, you're telling us to come now. So just packed their stuff, got ready, and came to the event, and they're sitting in the audience here, right? And I think that's a testament to what founders need to do. I remember I used to sell a hangover product, and I really wanted to meet DJ Akil and be a part of his club launch event. A friend connected me to him. He called me at 11 p.m. and said, hey, I'm going to be at Sahara Star right now, so can you come and meet me? At 11:15, I got in my car, I drove from Mahalakshmi to Sahara Star, and I met him at 12:30 at night. And that's what you got to do, right? Because things will be tough, things will not come on a platter, and things like these that you do when you get out of your comfort zone go a long way in the future.
I would like to say focus on what you want to do and focus on the vision. And something which my father taught me, key opportunities will create miracles for you, but more than that, if you continuously do what you want to do, till the time you do not achieve it, you will be successful. So I believe continuity is very important when a founder is running a business.
Rightly agreed, Jeet, with you, because I have seen a lot of co-founders and a founder, when a question is being probed to them, suppose if you will not get a funding in, let's say, 3 months or 6 months, then the answer is very simple. We'll wind up the startup and we'll go to the corporate life back. So what you said about continuity is really right. Utpalji.
I'll just say two things. First and foremost thing is basically the differentiator. What are you bringing to the investor? I think so that's how you will be evaluated by an investor. Are you just following something which is a successful model, which is run out of the mill? Or are you really looking at the problem and finding out a solution which is not a short term? It is something which is a long term, which is sustainable. I think that's the first and foremost thing. And second, when you actually approach any investor, imagine you have a very limited time span. Probably the meeting could be 10 minutes to half an hour. But if you have not rehearsed well, everything around your venture, be it the team, be it the product, be it how you look at the market, and how are you going to scale up? Unless until you are not prepared, you are not rehearsed, the attention span of an investor will be probably 2 minutes. He will gauge it, and that's end of it. So I think rehearse around your product, around your team, and around your venture. I think so that's the most important thing that any founder should do before approaching any investor.
Ashishji.
Each time that you're looking at pitching to a VC, rather than cold reach, try and figure out their portfolio company. We are in an age where the information is out there. Make sure that you make the reference out through their successful portfolio founders. That gets you ahead of the queue like nothing else. And the second thing that I will definitely want to put out there is, I think it was mentioned earlier as well, that there are two forms of funding, and your revenue form of funding is much superior. So don't get into advice, no matter how ambitious and cool it looks. Go with your own conviction and belief. Listen to everything that's available, but ultimately you have to underwrite your actions and face it alone. So factor for all of that and take it over. Thanks.
Rightly said, it's a business and a cash flow focus. Revenue is the first source of funding rather than equity funding. So I think that's very good advice for all the co-founder when they are raising the fund. Considering the time, I will request the audience to come with their questions with our panel.
Yeah. Hi, Ashish. Hi.
Yeah.
You just mentioned that rather than reaching you directly, then people should come via some or the other funds in which you have invested or companies. Can you please elaborate that?
On an average, most investors will end up getting, at least we do end up getting about 4,000 pitches in our mailbox in a year. That brings it down to more than 300 in a month. And there'll be definitely some filtering mechanism, which means that I am unlikely to get a chance to read every pitch. Rather, I'm not reading every pitch. It's an open disclosure. And if you have got one of my co-founders who we have been successful with, you can reach out to the wrong person in the team because that co-founder I am not on the board of. You could have gone to Karthik. He doesn't do fintech. That is still fine. Or I don't do deep tech, but a founder of mine said that I know this person, you must meet. It definitely has put you in at the top of the stack. Now you can say, तो सिफारिश मांग रहे हो आप? Fair, इस तरीके से देखना है तो उस तरीके से देख लो. I am trying to highlight the manner in which you have to beat the queue and get at the top. Simple. All legit means are welcome. As a founder, you have to hustle a lot. I am giving you one trick onto that, as straight as that.
Justified. Thanks.
Yeah, I completely agree. Like, I think my LinkedIn inbox is flooded, but people now reach out to me on Instagram. I get less messages on Instagram, so I reply faster there. I think it's a big country. There's a lot of startups, lots of pitches coming. If you can find the most creative or effective way to reach out to the investor to get the meeting, follow what Ashish said. Makes sense.
And as an angel as well, I should tell my portfolio founders, you don't reach out to the VCs directly. Their chances of you getting a call are much limited. You tell me when you want to, I will reach out to the correct guy, the right analyst, associate. And as Ashish said, sometimes you don't need to go to the top. Analysts and associates, they are essentially the gatekeepers. They're the ones who are going to filter out and do the first call. So we will reach out to the experts in that space, do a warm connect. And most times they also, they know the kind of deals we get to them. So they ensure that they at least get a call. And post that. So basically our job is to open the doors. Eventually to make it stay open is the job of the founder, of course. But opening the door itself is a huge task. And it always helps to have a warm connect.
Agreed. Innovative ways.
Yeah, hi everyone. My name is Nirav Mehta. I am the Chief Strategy Officer of a material science startup, and it has been revenue positive so far. My question is to all of you. Typically, we talk about B2B, but there is a lot of less focus on B2B material science as a domain, which is considered to be very R&D heavy, and the gestation period from a lab to commercial scale is challenging. When we have already cracked all of these things, what should we do to reach out to the right partner for funding? Because it is not just concept selling to the consumer, but it's also concept selling to the investor fraternity.
Yeah, sir, I think, thank you for your question. There is actually now a large set of investors in India who look at this and who invest in these kind of businesses. I am the exact opposite and I'm the wrong person to reach out to because I don't invest in these kind of things. But there are a lot of people who have done similar investments, similar deals, and who have thesis in this space. Reach out to those people. And I can guarantee you there are people who do this. It's just, I would be the exact wrong person, right? So if you reach out to me, I will even have no value to add to you because I don't even understand the space. But I'm sure Sid and Ashish may be able to sort of add more value.
One need to understand, what's the reach of cybersecurity and where it is going to be applicable. I suggest, probably there's a lack of understanding for the investors that you are approaching. So I think identifying, what was just mentioned, is identifying the right set of investor. Who is the right set of investor who are investing into this? Make them understand, what is the reach of cybersecurity, where it can work and where it cannot. The moment it happens, investors will have an understanding of how it will help others and how investors will make their money. I think so. Ultimate aim of investor is basically how they get their return. So if you couple both, so I think so. The way you should be putting it is cybersecurity is one of the most important area that we also believe, as a VC. The only thing is, if you pitch right, if your thesis is right, if you are able to show the differentiator and the value addition, I think investor will fall for it. I don't see that investors are shying away from cybersecurities.
Before we get maybe two more verticals. The earlier question was on material sciences. Now you are talking about cybersecurity. The concerns are legit that there are some things that get less love and there are some things that can get much more funding than probably one can imagine and get their heads around. I'll definitely say two things. Number one, some of these things are a function of eventually a little bit of a lag that happens between different places and different countries. We had a fair bit of funding on things like neobanks or in crypto. In some cases, things have gone south. BNPL, for example. When you talk about some of these things, people have burned their hands in trying to figure out, okay, I'm going to plonk in a lot of money. So there is going to be healthy skepticism that exists. For every vertical that you belong to or you're trying to patiently solve a certain problem, I would urge you to do two things. Number one, for what you are doing, there are associations, organizations, or a clutch of people who are trying to do something similar. There is an important thing that you get out there and help shape the thesis. Because the best of companies who have become market leaders were lonely in some or the other space that they started off with. And there has been a positive contribution to adding to the thesis. You are saying you're trying to force me to do your job. I agree with you. But if we are really passionate about a few things, we'll have to do it. The same thing happened with some of the early fund managers in India also. And there's no shortcut to it. So I would definitely say take the content route out, take the collaboration route out, and be out there. Some things will take time, and you'll have to bide your time into it.
So here.
We just go ahead with one last question, please. Thank you.
So one question. One of the thought that we have discussed was we should have more than one founding member for the business to be sustainable for a longer term. The question here is, how do we really identify whether the founders are in sync or not? Because when we see a pitch deck, when we have a first round of meeting, generally we find all of them are in sync, but the reality may differ. So what are the key parameters that you guys look at if you want to evaluate the sync between the founders?
I'll just quickly go in first, others can add. But our realization is that it does come down to one dominating founder. And no matter what level of sync between 3, 4, 5 founding teams, at the end of the day, we do feel that it's like driving a car. And the steering wheel is to be in the hands of one guy. To the extent we can get the conviction that this is the guy and others will gel around it and be able to take it forward in sync. It is much easier rather than to try and say how each one of them is going to be in sync. I can also tell you that in many of the conversations where there's a very wide founding team, not all will be given enough weightage in the assessment also. And this is exactly the outcome of that. Even at a scaled up stage, sometimes co-founders who's holding 50%, you realize that there is not much of a contribution or much value add. And either the guy falls by the wayside or he is holding on to the position for needless reasons. So it does come down to that one guy and the ability of that guy to keep the flock together. And that is more important for the VC to assess, by and large. Very few teams where 2 or 3 are equally relevant, equally adding. And that does show up in the way the equity is distributed amongst themselves also.
Yeah, just add to what Ashish said. I think we always end up asking the question, who is the CEO, right? And that alludes to what he's saying. Having said that, I think that, like, for example, I built a business with my wife. She was the CEO of the business. There were certain functions that couldn't happen without her. The crucial questions, and again, you've asked a very hard question because I can meet a company 2, 3, 4 times before I invest. I can't meet them 100 times. I can't see what they do outside of work. I can't see how they interact. I can't see their WhatsApp chat between the co-founders. I can't join their WhatsApp group, etc. Right? So I think one metric that I like to look at is, see, there's lots of these conversations about speed date a co-founder. People send me a message, I want to find a co-founder. I want to see a co-founder. Do you know anyone who can be my co-founder? Actually, initially, when you sign on someone as a co-founder, it's honeymoon period, everybody's happy, etc. all of that. But in 5, 7, 10 years, you're going to have lots of tough times, lots of moments of conflict. If you don't know the person really well in those moments of conflict, you don't have a relationship, you don't understand them as a person, it can lead to serious issues. And so when I look for a relationship, I say, do they even know each other? Have they had context? Are they friends from school? Are they friends from college? Have they worked together? Have they seen themselves in different kind of environments and complementary skill set? I think these are the 2 things that I try to gauge. Having said that, in 2, 3 meetings, you can get it wrong. But at least have this framework to try to get it right. That's how I think about it.
Thank you.
One last question, please.
I can just say one thing. The evaluation of the founding team starts from the minute you start pitching before investors. Whatsoever, the sync, the kind of understanding, the kind of passion. Investor will evaluate the moment you start, how you are thinking, how you are giving each other a space to, share their views, share their thoughts. Those minute thing also does matter for an investor to evaluate whether, there is a coordination, there is a sync between the founding team. So I think this is the most important thing. So just to say that, while you believe that, there is a proper coordination, proper sync, you look at from other side of it that investor is, watching every minute thing. And believe me, if there are few investors who are sitting there, few of them are just monitoring this. So, that's basically my...
One last question from my side, please.
And a small point here in Hindi. मतभेद हो सकता है, मनभेद होगा तो नहीं चलेगा लंबा. Valuation भी नहीं आएगा. VCs can read very easily that.
One last question. Hi. So this is Ashwin Naik, filmmaker and entrepreneur. So I'm going to ask this question on behalf of a lot of entrepreneurs here. That what do you think, or do you think the investor mindset will change from revenue-driven kind of valuation of a company, idea, startup, whatever it might be, to a user and data/value-driven mindset, like how WhatsApp did not make a single penny and got valued for $19 billion. Similarly, do you think that India can have multiple Silicon Valleys or one valley where doesn't matter if revenue is not there, you're doing something good, you're getting users, you're getting growth, you're going viral. That's how the next Facebook and Insta will come from India.
Sorry for breaking your heart or being controversial. My emotional side of it leads me to ask, to what end? And how many WhatsApps or how many such businesses where you can simply say that, oh, they eventually did deliver the certain value, so they should keep on supporting. The founder pool of trying to solve a fundamental problem is limited, and so is the capital. So it will definitely gravitate towards the least amount of risk for the maximum possible return. There is optimization that happens in the minds of the investor. You might argue and say, no, but that's not healthy. You are going to not fund companies which could derive value. But ultimately, let's face it, 100+ years of bourses that have existed worldwide have shown that cash flow rocks as the ultimate metric of valuation. Value per user, value per page view have not landed anything out beyond a certain vanity metric and a certain boom in the market and getting headlines in the paper. No matter what you do, it has to be proven someday. Proof of work is well founded as a construct now, and the proof of concept is a cash flow.
Right. So in the same question itself, what I've heard from my friends in the valley is that even if the supportive nature of the investors and the founders, that bonding, that kind of camaraderie, that is something which is lacking here. So do you think that can change in the future, or are you doing something?
No. I completely disagree there. I think that's a massive generalization. The Indian startup ecosystem, I've been a part of it for the last 10 years. I see massive camaraderie, massive relationship building, lots of events like these, and there's lots of WhatsApp communities, lots of founder communities, investor communities, founder-investor support communities. So I think, yes, maybe our ecosystem is a little bit more nascent and newer, but we are moving well forward in the right direction. So I wouldn't make that generalization at all.
And just as an anecdote, for us, see, people keep asking us, when we are raising capital for fund as well, is to what is your deal flow? Why would a founder come to you? And we tell them that, see, all three of us partners, we have more than 250 companies in the portfolio as angels and as VCs as well. And we say our best in terms of intro is when somebody in the network, they're building, the founders first come to us. And that itself is a high mark that things are going well between us. So yeah, as Arjun rightly said, things are going really well between investors and founders. Maybe it might be a few anecdotes that you would have heard, but overall it's all good.
Let's put it statistically. You don't have enough cases in India where investors have colluded to change CEOs in a company. Absolutely. You look out there in the West and you will see enough of those examples. Good and bad both. I'm just trying to highlight a point which does probably not validate what you said fully.
Thank you so much.
Thank you so much. Friends, I apologize, but trust me, we do have the lunch time. Rajesh, you want to take one more because they're very excited. He's already holding the microphone. Sir, short rakhenge, short, one sentence.
I've just been waiting to ask the question for quite some time here. The esteemed panel is under consensus that we need to have some revenue and some things that they need to create value, or the road to profitability should be there. But what about deep tech startups? And by deep tech startups, what I mean here is not somebody who's AI powered and can create it, let's say, arguably in 6 months, but somebody that actually requires that kind of R&D and collaboration with institutes and have real IPs and scale up from there. So, I mean, I agree that the era of 21, 22 of blitz scaling is over. But where do deep tech startups lie now in India? Because now the models are not just that we are copying a Western model and just replicating and Indianizing it. We are doing something truly original as well as a country. Do we go to the Western world for the funding, or is there a place for deep tech startups in India? I would like to.
Thanks for asking that question, and thanks for allowing that as well. It allows us to balance out. It's a very important one. So when we are obsessing about revenue and trying to highlight the need for cash flows, we are not trying to say that what needs a certain gestation period should not be allowed. Let's be very clear about it. For a certain innovation to hit the market, a certain capital is needed. So that's not debate at all. The key point that is highlighted is when it comes to deep tech, you will have to take a slightly longer journey, and investors who are looking at coming in will have to have that mindset to go through that. That's why today now you see the era of generalization is over, is what my humble submission is. Like founders have specialized in a few things. Earlier, any founder could start anything. The first batch of founders didn't come with exact experience. How can you? Because there never was an e-commerce startup that existed in India before 2010. So if somebody was starting up a commerce company, how would you have worked in that? So that era of generalization is over. Similarly, in the VCs also, things are moving to a point where there is a high degree of specialization. The evidence of the fact is that for the first time, we are seeing very, very sector-specific funds. They do have the mindset to be able to look at and raise a fund which is a 12-year fund at the bat versus an 8+2, which would have been a common notion. And now you are hearing it much better from the government as well, where they have been the biggest champions in India. A fourth of the capital or a sixth of the capital in exact terms has been through the government pockets of some or the other nature. They have also started to acknowledge that if we are funding in a deep tech-centric business, we will have to have a deeper period for the fund to close down. So things are changing, and it's a well-deserved question and should be addressed separately.
I think I want to add something on this. Government of India is coming with semiconductor national plan. I think that will make a lot of cost reduction for AI and deep tech startup also. And they are going to make processing capacity available at a much cheaper cost very soon.
Sir, one last
Let's
question,
answer the last question. Sure, go ahead, go ahead.
Myself, Sahil, we are a startup of InsurTech platform. One basic question for everybody. How do you assess the scalability and growth potential of any startup? I repeat the question. How do you assess the scalability and growth potential for any startup?
Like I said before, in the mind of the VC, either there is combination of intuition plus a sector preference or a understanding of the vertical, or there are people like us, some of us, who would go out, put out explicit thesis on a subject. So when we are doing that thesis, there is a certain amount of conviction that is built in the space per se. That becomes a starting point. And then when you are seeing the founder, you are basically approaching the sector in that lens of your research, your work. So 5 years earlier, you would have asked for an EV. You would say, how many companies will move into the EV zone? The share of EV today barely has touched double digits. So how one would have evaluated. But we did go and take half a dozen bets. And there are enough investors who go thematically and take all sides of the market. Some thematically go and take all sides of financial services. So that thesis in the head of the founder, ability to try and draw lines or take learnings from other markets. However, most pragmatic investors don't simply say that I'm okay with a copycat model. You're not going to invest in a sector just because it has worked well in China or the US. You will try and localize. So that is another aspect of the thesis building. You will go and figure out, yes, something has done very well. Financial services and payments did well in the US. neobanks did incredibly well, but India, the regulatory system is very, very different. So it will not work unless you own the customer experience from a regulatory standpoint. So banks will have the largest say in the whole game. So that allows us to judge whether we are going in or no. And after going in, you are trying to do a few things I said earlier on the valuation question as to how this is going to be done. That I answered already.
Thank you very much.
Thank you. I truly appreciate your keen interest. Thank you so much, Sridhar. But of course, feel free to ask them questions during the lunchtime. And then we do have the networking time towards the end of the day. But for now, let's please give a huge roar of applause for our distinguished panelists. So the session is so interesting that the questions don't seem to end. I'm going to please request you all to kindly join us for a group photo op ahead of the tables. And we'll also like to felicitate and present a lovely token of love, a memento. Can we come ahead of the tables? Sab ek saath aa jayenge for a group photo op. On behalf of Bizdateup, we are truly thankful to all our distinguished panelists. Ladies and gentlemen, one more time. Let's continue the applause. As I'm going to please also thank DBS Bank and request my distinguished dignitaries from DBS Bank to kindly join us here and present tokens of love as mementos. Sir, please hold on. Please ruk jaye, sir. May I please request Mr. Amit Bansali, Sherry George, and